Hi there. Thanks for tuning in. Today, we're going to be doing an analysis and valuation of Correios de Portugal. And this is a company that is partially a postal service and also that has subsidiaries operating in banking, e-commerce, and different postal services such as parcel delivery and whatnot. And it's pretty cool. It was founded in 1520 by King Manuel I of Portugal. And CTT just means Correios Telégrafos Telefones. So that's a very old, interesting company. However, in 2014, it was privatized by the Portuguese government. So that's important to note. There's not much government oversight, although they do have to abide by certain regulations, as any postal company does. So that will limit certain things it can do, but not as much as you would think because it is fully privatized. Now, let's get going with some numbers. So, first of all, the big thing is that it's adopting, or the adoption of e-commerce is making everything grow greatly for their parcel delivery services. So their profits have been amazing lately because they deliver in Portugal and Spain. And you can see here that e-commerce penetration in general is really not that big in Portugal and Spain compared with, first of all, certain places in the world like the US, UK, Sweden, China, South Korea. But even for European standards where e-commerce adoption is a little less big, there's just so much more room for growth here, especially compared to peers like Germany, Ireland, Denmark, and the UK, of course. So e-commerce is basically growing in the Iberian Peninsula big time, and that gives them a significant upside. They also just are gaining in express and parcels, of course, but even the mail, they're doing pretty okay. In their financial services, they seem to be struggling a little bit, and that is just a little bit difficult because of the public debt placements and also the fact that there's strict ceilings there to the debt placements that they can do. So that's just something that will always limit them a little bit, and that's where the regulation part comes in. And then their bank has some profits here, but very minor compared to everything that is mail, but the express and parcels, which is the main bulk of what they earn. And this is just talking about the latest quarter, first quarter of 2024. So that's the difference. It's been a little lower of revenue recently, but that's straight up because of the abnormal situation in public debt placements. This is something that is supposed to revert. So they still expect a pretty good year. Now, they're going to grow a lot in 2024 according to their projections because they really beat revenues. They beat it by a lot recently, and they think they're going to grow by mid-single digits in 2024 and keep going for 2025 and onwards. Again, mainly driven by this mail and express and parcels growth that has been happening. So, there's something else to note, free cash flow, the number is a lot lower here in the first quarter of 2024 compared to the first quarter of 2023. This is mainly because of the low debt placements, which hurts all the way to the net profit here, and then take away some items because of some payments that they have to do for free cash flow. So free cash flow is a lot lower this quarter. So that's something that's going to be interesting. Can they make up the difference here? And if so, do we have to project something there? Well, we'll see. But they're saying that free cash flow is going to improve throughout 2024. It's great because at the end of the day, their net cash position is very healthy. Their financial debt is in the negative, so they actually have positive cash, more cash than debt. This is great to see. But overall, the picture seems to be pretty good, and they are going to just improve in free cash flow throughout the year, hopefully. We'll see. Now, they also have so much flexibility in their balance sheet. I mean, basically, the net debt to EBITDA can be all the way up to 2.5 times. Really, right now, it's much, much lower than that. It's 1.3 times, allegedly, although the net debt is negative, so I don't know what that number is about necessarily. But what they're saying here is, hey, if we want to expand, we can take up a lot of debt, buy things that'll expand our growth, that'll help us keep growing. So they have a lot of flexibility there, even with a free cash flow. They have a ton of stuff that they can do with that cash, with the EBITDA. So that's great. They have options, even if it's just buying back shares, giving more of a dividend, or making an acquisition, expanding further. So we like a company that has options and that can fuel their growth. They also have a very nice dividend that has been growing recently, and they have share buybacks, and they buy back a ton of shares every single year. So that's great to know. So you're definitely getting cash back as the shareholder. this is what we like to see in any company that we invest in. So I'm going to do a model here. It's going to be very simple. I'm going to say 10% of revenues get turned to free cash flow every single year. This is about in line with their historical average, more or less. So, with that said, I'm going to grow revenues by just 2%. I'm just going to say 2%. Why? Because even though they're projecting higher, maybe there will be a little bit of a mini recession in the Iberian Peninsula. Maybe growth slows down for X or Y reason. So it doesn't matter. I just want to account for volatility, be conservative, and just say, hey, 2% is your rate of growth from 2024 onwards in perpetuity. Now, I'm going to have a required rate of return of 11%. And if you grab these two numbers, put it in the discounted cash flow model, and divide it by the total number of shares out, you get a fair value of 8 euros and 32 cents. However, if you add the net cash that they have there, you also get a value post debt of 8 euros and 78 cents. So let's see where Correios de Portugal is at the moment. Now, this is interesting. You are at 4.23 euros compared to pretty much double that I got in this discounted cash flow model. And if you'll see, they were even very low in 2020 in the 2 mark ish. So if you invested 5 years ago ish, you're very happy with it. You made a great investment. So good for you shareholders. And you'll see that the P/E ratio is pretty low, although I wouldn't be surprised if with this company it's always low, so I wouldn't pay too much attention to the P/E ratio, dividend yield of 4%. So that's interesting. So let's talk a little bit about this price differential, a little bit about why. So, is it worthwhile? First, ask yourself what is the catalyst here? What will make the price go from the current 4 to that 8? Just like it doubled before from 2 to 4, will it double from 4 euros to 8 euros? Well, something needs to happen. Is the e-commerce expansion enough? Is the Iberian adoption of e-commerce, of parcel delivery, is that going to be it? Or is it something important like an acquisition that they can make, which they do have space? So does something else need to happen in order for that to go up significantly? If not, it may be a very slow burn where the chances of it of you losing significant money with Correios de Portugal is probably not too high. But the chances of you doubling your money may take a little while if there's no immediate catalyst. So it may be a very slow burn that you'll have to hold over many years to just double, triple, quadruple your money. Although at the same time, you do get your value returns through share buybacks and a 4% dividend. So that's what you're getting paid to wait. You're getting paid 4% on your cost in order to wait. And if you're fine with that, getting paid that 4% plus whatever the share buybacks do, to just wait and see when the catalyst plays out, that's interesting. And you also have to ask yourself, where does regulation limit CTT? So you just have to ask yourself that to just see if you're comfortable being in an industry that at the end of the day will have to deal with the European Union bureaucracy in some way, shapes, or forms. Regardless, in absolute terms, it looks pretty good to me. It's a decent business, and I think it has plenty of room for growth as long as the European economy holds up, of course. So, what I leave with here is where are the catalysts, and that's just to expect a certain time frame. If there's a catalyst, then maybe your investment could be a 2x, 3x in a year. But if there's no catalyst, be ready for the long run, be ready for a slow burn. This may be the case with CTT. We don't know, of course, but that's why you also have to back it up with a model, with qualitative analysis to just see if, regardless of a catalyst or not, it's still a great investment. Now, I hope you got a lot out of this video. If you liked it, don't forget to like and subscribe. Comment down below if you want to see me analyze any other stock. Thank you so much and have a great rest of your day.